And there it is, the closing bell at the New York Stock Exchange. The Dow Jones had a strong day, ending in positive territory. The industrials are up about 250 points.
The S&P 500 stayed fairly flat, but the Nasdaq spent the day in the red as Netflix stock fell drastically after its quarterly earnings posted after the bell yesterday. Michael Pachter joins us now for more. He is the managing director of equity research at Wedbush Securities. Michael, thanks for being with us. We know what the headline is as far as Netflix goes, but the Dow seemed to shrug it off. Can you just give me a sense, your sense of what was driving the market today?
I think that Netflix is a bellwether for growth, and the Dow isn't really a growth index. So people look at Netflix, and obviously you're familiar with FANG. It's the N in FANG. And so if Netflix isn't growing, oh my God, nobody else can either. I think that that's probably misplaced concern. And I think that Netflix is kind of, dying its own death because it's so far ahead of everybody else that, they've saturated the market, and they have the perfect storm of, a saturated domestic market, a price increase, which was poorly timed, loss of subscribers, because of sanctions in Russia, and then, the whammies of inflation, and people are really concerned about wallet share, and then competition. So just a lot of stuff happening to them all at once. They caught us flat-footed, not me, but they caught my competitors by surprise. And you had about a dozen downgrades today. So, I unfortunately for me, I've been saying this for 10 years, and I've only been right for the last few months. But everything I said that was going to happen 10 years ago happened yesterday.
Michael, let's dive down into those numbers a little bit more, because Netflix stock is now down more than 35% after reporting Q1 earning losses. Some other companies, as you mentioned, with streaming services also ended the day with some losses, including Disney, Roku, and our parent company, Paramount Plus. Is this a signal that it is time for investors to jump ship? You say no, right? You say tying Netflix into all the streaming services is a mistake, correct?
I think that's right. I don't think that streaming is a zero-sum game as a self-contained industry. I do think that media consumption may be a zero-sum, but cable TV is going to lose. So, we're seeing people cutting the cord by about 3% a year, shaving the cord probably even a bit faster. And I think the end game is that instead of an $85 cable bill, we shave down to a $50 cable bill, and we pay $50 more subscribing to various services. Netflix is hurting just because they've saturated the market domestically. And so it's really, really hard for them to make gains when they're already at 75 million households, US and Canada. There's only 140 million households, and only 120 million of them have broadband. So there really isn't that much more upside for them. And remember, 10 million households are in poverty. So they're just not going to ever get to 100. And I think that just hit home today. That doesn't mean Disney can't grow, Paramount Plus can't grow. Your parent needs some more content to get there. But yes, they will. They're all going to keep growing. And I think that Netflix makes it easy for people to switch. So you see churning out of Netflix and into the other services. I think we'll actually be positively surprised when everybody else starts giving numbers.
All right, so let's broaden out a little bit into this question about tech and how it's going to do. You gave us a thumbnail on the Dow as not a growth-oriented index. What about the Nasdaq? A meh here at best so far. Where are we going? If you have your eye on the Nasdaq, in your view, what should people be thinking about?
I think people should actually recognize that, we're coming back to a normal world. Obviously, a war in Ukraine is not a good thing, but shelter in place is going to end completely. We're going to be back to normal lives and spending money normally. We've got to get past supply chain issues and high gas prices and inflation, but that's going to work itself out in a year. What we do have working for us right now is full employment, and that means people are making money, and they're going to have to find things to spend that money on, and tech is the beneficiary. So the Nasdaq, representing the much broader market, is going to grow at least at the rate of GDP growth, and those companies tend to have some leverage. So you're going to get earnings growth that's outsized for what we expected in the past, and I think Nasdaq's going to work. It will probably take a year before investors are really comfortable diving back in, but bold ones are going to wade in here. And today I had a bunch of questions. Where does Netflix bottom out? When can I buy it? So people want to buy these things when they're depressed,
Right.
and the tech has really cooperated. So is Nasdaq.
Michael Pachter sounding bullish, Managing Director of Equity Research at Wedbush Securities. Thank you so much for joining us.
Thank you.